Welcome back to the Financial Interest YouTube channel. My name's Dan. In this week's video, I'm going to look at how we can prepare for a stock market crash. And this is an event which we can really take advantage of to accelerate ourselves to financial independence. So let's get on with the video. So over the past few weeks, we've seen some major drops in the US indexes. So we're looking at the Dow Jones Industrial Average, the S&P 500, and also the Nasdaq. We can see the Dow Jones dropped 7.2% in 23 days. The S&P 500 was faring even worse, dropping 9.8% in 24 days. And the Nasdaq actually dropped 15.7% in 24 days, and is also down 16.8% from its all-time high on November the 19th. So although this has made correction territory, we're not seeing it as a crash just yet. So a crash would be something which is above a 20% drop, and a correction is typically in the 10 to 20% range. So of course, I don't know any better than anyone else whether the market is going to crash in 2022 or not, but what we can be sure of is that at some point it definitely will crash, and we need to be prepared for that moment so we can take advantage of it. So there's a few things we can prepare for while we actually wait for this to happen. I'm sure most people have heard of the saying, fail to plan, plan to fail. So like most things in life, success isn't an accident. It's the result of consistently sticking to a strategy and being able to adjust that strategy when required to keep on track. And obviously this is something that requires a plan and a lot of discipline. So a plan's important so we know how to act in certain situations. And because the market is very psychological, we want to take as much emotion out of our decision making as possible. Of course, everyone's plan and strategy is going to be different because everyone's individual situation is different. If you're close to retirement, you probably shouldn't have a huge amount of money in the equities market anyway, because you might not have the luxury of time to wait for the market to recover. And the things I'm discussing today is really looking at it from the perspective of someone who's got at least 20 years time horizon ahead of them in terms of making investments in the market. So the first thing we need to do is have a watch list of great companies. And this comes back to circle of competence and also Phil Town's 4M's approach, which I've discussed in other videos, and I'll leave a link to that as well. So we need to have done all of our research into a business, so all we're waiting for is the actual company to go on sale. And this means also keeping up to date with valuations. It's earnings season at the moment, so we're just seeing a lot of the 10Ks come out for US companies. So it's important to have the latest information when you're making valuations on those companies. And it's important here to always think of Warren Buffett and Charlie Munger, as they mentioned that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the next thing we need to make sure of is that we have money ready in our brokerage account for such an event. So it's always good to keep a certain percentage of your portfolio in cash to take advantage of events like a general market crash or, event in a particular company or industry, because you want to be ready to kind of take advantage of that as soon as you can. And Berkshire Hathaway is a good example of this. They hold, I think, around $150 billion. That's probably actually even gone up even more as of the latest kind of filings, but they were sitting on $150 billion in cash. And that allows them to kind of weather any storms that go on in the market and also be able to buy up whole companies or individual stocks as well to add to their portfolio to take advantage of this. And this is something they did very successfully in the crash in 2008 with the banks. And having cash in there is important because sometimes you need to act really fast. The March 2020 COVID crash actually only lasted for a period of a few weeks before the market started bouncing back again. So a lot of people didn't even have a chance to take advantage of that. And moving on, we also need to have an idea of how we're going to allocate capital in such an event. So you need to think about how much allocation you're going to spend on each thing. If you've got a couple of different companies who you kind of equally value, you need to think how you're going to allocate your capital to those. And you want to be also thinking about investing in tranches, so in smaller pieces, so that if the actual stock does continue to fall, you can keep buying in at lower prices, and therefore you're going to reduce your cost basis on the investment. And having a plan laid out before will help you kind of execute this without having to think too deeply about it at the time. And it's also a good idea to look at some of the previous crashes and how the market has behaved historically. So full disclosure on my side, I wasn't actually heavily invested at the point of the last market crash in 2020. So I'm still yet to experience how it feels to see your portfolio take a huge drawdown of maybe 30%. So it's actually going to be interesting to see what happens if I'm involved in that kind of situation, because until it really happens, you don't know how you're going to deal with it. So I'm just in macro trends here, so we can actually go and look at the Dow Jones Industrial Average 100 years of historical data. So we can see here that the market has obviously gone up and down a lot, but the point is it's always recovered from the crashes. So even if we go here where we've got the Great Depression, it took a long time, around 30 years, to actually get back to its kind of similar levels, but it did recover, went on to set new highs, dropped back down again, then obviously back up to new highs, then dropped down, and like so on. Obviously this is the global financial crisis here, where it hit that low and then obviously went on to set new highs. But you will see, obviously, going from one side to the other, the general trend is an upwards one. And this is why it's always important to look at a long-term time horizon. Of course, although the US has historically always grown, that's not the case in every market. Probably the most notable example of this is the Japanese market, the Nikkei, and we'll go and take a look at that now. And here we're looking at the same chart for the Nikkei in Japan, and you'll see here that it shows the last 67 years and the current price of 26,717. So you'll see here that it was in a big bubble at the late 80s. 1989 kind of hit the peak. Let's just jump into a close-up view there. So we can see here the peak in the late 80s, early 90s, 38,000, and we're still way behind that, kind of 32 years later. So Japan is really one of the main examples where it shows that it hasn't recovered, but that's not to say that given more time that it won't recover eventually. But you've always got to have a bit of caution whenever you're investing. So of course, based on what we've just looked at, there's no guarantees that the market is going to recover. But obviously in the case of Japan, no one knows how long it might take, but it's still possible that it's going to eventually get back to that level it hit in 1989 and then even maybe surpass it. Although the time horizon for this looks like it will be quite long because they're still a long way off. So we'll just look at a few key points just generally as well before I end the video. So the saying time in the market is better than timing the market. And this is really true when it comes to things like this. If we're looking at a long enough time horizon, it's better to just stay in the market and wait it out, because actually you end up losing more by trying to jump in and out of the market, because you end up getting out too close to the bottom and then the market's already bounced back before you go back in again. And this greatly affects your returns in the long run. And just to reinforce this point, we're just looking here at an article from Seeking Alpha. So this is just basically going over things to do with market crashes. But as it says here, long-term investors shouldn't get caught up over short-term market gyrations. Markets drop, but after each time the market recovers, sometimes immediately, but sometimes it might take a bit of time, but the recovery does happen. And this is an important piece of advice as well. If you can't stand the volatility of the markets, then it should change your asset allocation. And really, the long-term outlook is an important part of this as well. It mentions here, look back at 2008, after the 35% drop, the market proceeded to triple over the next 6 to 7 years. And then the most recent crash when COVID hit, the market lost a third of its value in 5 weeks and took just a few months to recover those losses. And the investors who wait on the sidelines until they receive some kind of indicator that the market is heading higher are inevitably the ones who are going to lose out. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. And also consider subscribing to the channel as well. It really helps me out. It'd be great to see if I can grow a bit more this year. And I appreciate everyone who's been following on with what I'm doing so far. And let me know in the comments below if you think a crash is coming, or if you've got any particular other advice you would give to investors out there of how to deal with a crash if you've already been through one before. So thanks for watching, and I'll see you in the next video. Cheers.